Guys, we know that the price is likely to return to the fair value gap to trade it. But did you know that if the price moves significantly away from the fair value gap and fails to come back, this could provide important information about the market's future movements? Did you have any idea which fair value gap can cause you to fail? There is only one profitable trading opportunity available, which is based on the fair value gap that is covered behind the secrets. And we will try to reveal that hidden knowledge to you. Can you find the exact fair value gap that gives us the best opportunity to execute a successful trade in this chart? If you are not confident, this is the video you have to watch. Let's start with this question. What is the fair value gap in trading? The fair value gap in trading is a price pattern that can be observed on a price chart. It consists of 3 candles, where the central candle is significantly larger than the previous and the next candles. The nearby candles have upper and lower wicks that do not fully cover the range of the larger central candle. This pattern suggests a sudden price surge or decline that happens too quickly for buyers or sellers to respond effectively, and it creates an imbalance in the market. Let's see the psychology behind the fair value gap. We know that this big candle as the price move is not created by retail traders' trade. Maybe someone with big money comes into the market and wants to move the price higher. We know the price will be determined by the central bank. Every trader enters the market with the aim of making a profit, and each trader has their own strategy to achieve this goal. Therefore, it is difficult for me to believe that the significant and sudden market moves caused by central bank trading strategies are not primarily focused on generating profits for the banks themselves. So do you know how they make money? It is so simple. Every time the price moves significantly by a fair value gap, it creates a strong attraction for retail traders to enter a trade by following the price direction. In order to make a profit, institutional traders often make a significant move to attract traders and push the price towards their funded position. This move is often too difficult for others to follow. But once the institutional traders reach to funded position, they need buyers. That is how they can exit as funded. When retail traders are entering long, they are selling, and that is how the price will retrace to the discount area. So if we take a closer look, we can see they are entering a long position in the market discount. By pushing the price significantly with a fair value gap to equilibrium, they reach the funded position. Then they start selling in premium. And that is how the price will come back to the discount, and it will fill the fair value gap too. This is happening in the market every day and every minute. Let me tell you a secret that no one talks about it yet. Guys, we believe the price is likely to revert to the fair value gap to trade it. But every time the price leaves a fair value gap behind, and you find no return to it, that's because the market direction is about to leave it behind. For example, in this chart, if we zoom in on this area and switch to lower time frames, we can identify this fair value gap as the one. Price's next move is not return to it. So in an uptrend, every time we identify a fair value gap that price leaves behind, that indicates a bullish market. You can apply this to a bearish market too. Now you know everything about the fair value gap. It is time to discuss how to identify the fair value gap in trading. But before starting of next part, please like the video if it provides you with valid information. There are 2 steps. Step 1. Find the visually representing price spikes or drops and look for a central candle that stands out from the adjacent ones. Step 2. When analyzing the previous and next candles, check if their upper and lower wicks overlap the range of the central candle. If they do not, it indicates that there is a fair value gap. I want to let you guys know that I also share trade signals completely for free. For example, just recently, I called that Ethereum was about to break out, and just 2 days later, it shot up nearly 5%. If you want to see more of my trades live, join my free Telegram community. Link is in the description. Now, back to the strategy. Here is a clear example. If you're interested in a trading strategy based on a fair value gap, here is a step-by-step guide we will share below. Time is the most important concept of this strategy. Despite the Forex market being open 24 hours a day, there are just specific time zones where high trading setups occur. Higher probability trading opportunities occur during specific time periods associated with the entry of smart money. These institutional banks have the ability to influence market direction. There are 4 major trading time zones: London Open, London Close, New York Open, and New York Close. Guys, after all this explanation, now we know every time institutional traders or banks create drastic moves on the chart, they are manipulating the price, and that is how they make money. These drastic moves are signs for us to know that smart money is in the market. It is time to show you how you can execute a successful trade based on the fair value gap. Every time institutional traders or banks push the price drastically, with a fair value gap above the equilibrium after they sell, they will let the price retrace to the discount because they want to buy again in discount. So every time we identify a bullish market, a drastic move, and a fair value gap in the chart, we will determine the equilibrium. Then we will wait to price retrace to discount. When the price reaches the discount and fair value gap, we should wait for a price reversal during one of the 4 major trading time zones. This will be our trade opportunity. Due to the high risk of trading based on just fair value gap, we highly recommend our simplified consecutive order block trading strategy because of its low risk. In the upcoming videos, we will be discussing more confirmations such as equilibrium, discount, and premium. If you are interested, please subscribe and turn on notifications.